Hello, can you guys hear me?
Yes, ma'am.
Okay, good. I had some technical difficulties with Zoom the other night, so just wanted to make sure you guys could actually hear me. Okay, just gonna share my screen. Okay, can you guys see my screen?
Yes, we can.
Okay, awesome. Sounds good. So I'm probably just gonna wait probably 5 minutes after just to let everyone join, and then I'll get started. I guess while we're waiting for people to show up, do any of you guys have any questions starting off before I start this presentation that you're hoping to get answered? And if it's going to be in the presentation, then I can tell you. But if not, then I could maybe try to answer some questions before we start.
Yeah, I actually do have a question. So we're going to be starting residency this coming year. And so I just kind of, we've obviously match day hasn't happened yet, but we are trying to decide, are we going to rent? Are we going to buy? But I wasn't sure I've heard of physicians loans or mortgages, and just wasn't sure what the requirements were when it comes to, like if you have to be have a contract for a certain amount of years, or that proof that you're in the area and you're working, or not sure if we can do it the first year. So sorry, I'm trying to form my question. Just trying to see if that's a possibility for the first year, and
or when you've just barely matched, right?
Yeah, I don't know if it's recommended to do that, but
so I mean that's totally up to you. You should be able to qualify for a physician loan though. All you'll need to do is after you match your program that you match to is usually really quick about it. And they'll try to get you a contract, like a signed contract within a week or two, and even faster if you need to. And all you really need to be able to qualify for a physician loan is, of course, they'll need to pull your credit and make sure, like they usually don't include your like medical school debt into the calculations for qualifying for a house for a physician loan, which is really nice. But then they look at all your other debt, and then they look at your residency income, and then they'll qualify you for a mortgage in the area based off of your income, and based off of your contract. You can start a physician loan. You can close on a physician loan up to 90 days before your contract start date for residency, which most residencies start by July 1st. So, I mean, we're March, April, May, June, July. So, I've gotten people, I'm here in Utah. I'm a realtor and a mortgage loan officer, and I've helped people who have matched. Literally last year, someone matched on Friday, and I got them under contract on a home on that Monday. And they closed 30 days later and moved in. So.
Okay, that is really good to know. Thank you so much.
Yeah, no problem. So yeah, when we're talking about shopping for physician loans, you can do that for your situation for residency if you decide you want to buy. So
okay, perfect. And then does it just vary by the lender what kind of options there are, or is it pretty much kind of all the same?
So yeah, each lender, and when I say physician loans, because I know there's gonna be some like just for general, anyone who's listening, for physician, when I say like physician loan, I mean physician and professional loan interdependently, meaning like if you just graduated from pharmacy school, or if you're a pharmacist, or if you're a lawyer, if you're a dentist, all of these professionals fit within the physician or professional loan. So depending on which lender you go to, some lenders will have different requirements. Like, some lenders need say that you need to have like 6 months of reserves in your account to be able to qualify. Some physician loan lenders do 0% down. Some do adjustable rate mortgages. They're kind of all over the place in what they offer, which can be kind of good because you can find one that works for your specific situation. But it's good to shop around to figure out which one would work best for you. Did that answer your question?
Yes, that did. Thank you so
Okay,
much.
awesome. Okay. All right. So we're 6:04. So I think I'm going to get started on the presentation. Feel free to interrupt me if you have questions. We can kind of do that more on this Zoom. One sec. I just want to make sure that this is being recorded as well, for everyone. Um, for
It
everyone.
shows on our end that it is.
Okay. Okay. Awesome. All right. So now that we're 5 minutes, hopefully people who are joining are able to catch on. But I'm just going to go ahead and get started on the class. So this is how to shop for a professional or physician mortgage. Like I said, depending on the bank you go with, sometimes they'll be a little bit more picky on who qualifies. Sometimes like they'll let like PAs qualify, and sometimes they won't. So, but for the most part, most professional mortgages include doctors, lawyers, dentists, and pharmacists in that professional category. With that, and like I said, interrupt me if you guys have questions. So with that, we'll go ahead and get started. So this is just a little bit about me. This is my cred. This is how I'm able to teach this class. I was a mortgage loan originator for 7 years. I actually just barely let my license lapse this year just because I've been really busy with my other side of the coin that I do, which is real estate. And I enjoy that a little bit more than I do mortgages. I was a mortgage loan processor as well for 10 years. And so the reason why you see this class, so this is a how to shop for like a mortgage. A lot of the principles apply to physician loans and just general mortgages. You don't see this class taught a lot because mortgage loan officers are financially de-incentivized to teach you this, because if we teach you this, then you'll learn how to shop around, and then we'll have to cut our commissions more. We would. So you see a ton of first-time homebuyer classes taught out there. You don't see this one taught a lot because the people who are qualified to teach it don't want to teach it. Now, since I'm not a mortgage loan originator and I do more primarily real estate now, I like to share this knowledge so the people who like work with me or for my friends, that they're able to get a really good deal on a mortgage and that they know how to shop around. So that's kind of my cred. The page that I originally wanted to post this on suggested that I do some conflicts of interest, which I think is good. I want to be completely transparent, and I want to try to be as unbiased as possible in this presentation. So the first thing I'm going to say is realtors are required by law, and I'm a realtor, so I have to fit within this. If I give you a name of a bank to shop at for any reason, I have to give you at least 2 options. I can't like steer you. It's the anti-steering laws. And so in the spirit of being completely and totally transparent and trying to be hands off and not steer you anywhere, I'm not going to give any names out in this presentation. I know a lot of you will probably ask me in this presentation, who should I get a quote from? Who should I shop around to? My goal in this presentation isn't so much to tell you where to go. It's more to teach you to know how to shop around so then you can use your resources and connections to find someone to shop around to. Because I really try to be unbiased and not steer you to any certain place. And I can give you resources and websites, and Facebook is a great place to search for other people's recommendations, I can do those types of things, but I'm not going to do it in this presentation. So if you have specific questions, you're welcome to message me afterwards. So some of the other conflicts of interest that I have. So I'm a licensed realtor in Utah. I could be indirectly financially incentivized for you to get a mortgage if you were to buy in Utah and use me to be your realtor. 90% of people when buying a home need to get a mortgage. So if you can't get a mortgage, then I lose 90% of my business. So that could be a conflict of interest. Another thing to keep in mind, and this is probably the most important thing for you guys to know, not just about me, but just kind of as the business in general. So lenders try to win my referrals as a realtor. The way that most lenders or banks get their clients is by a realtor referring them the clientele. So I am constantly being solicited and people are trying to wine and dine me for my client referrals. It is actually illegal under the Real Estate Settlement Procedures Act. It's called RESPA, for anyone to pay or receive a fee or a kickback or anything of value because they agree to refer a client to me or I to them. That's totally illegal. Unfortunately, they kind of made a loophole around that where I think it's kind of ethically ambiguous. And it's called a marketing service agreement. So I could enter, me as a realtor, I could enter into a marketing service agreement with any lender at any given time where they would agree to pay for up to 100% of my marketing, all of my marketing costs, which is thousands of dollars a month. And there's in the law for this marketing service agreement, there is no expectation for me to send them referrals, but 100% there's unwritten expectations. When I first started in the real estate business, I was told by my mentors that if I didn't do these marketing service agreements, that I would sink and I would just not be able to compete. So for my first 6 months as a realtor, I entered into one of these marketing service agreements with a lender, and their rates just weren't the best and their service wasn't the best. And so I wasn't like steering people to them. I was just having their name in the mix of people I would recommend. They weren't getting any clients out of it. And so at the end of 6 months, they came to me and they said, hey, look, this isn't working out for us. You got to start sending us more clients or we're just going to stop paying for your marketing. And to me, that felt like, okay, this is totally against RESPA. Even though it's like, okay, it's not okay. And so I currently do not, after that, I have never had a marketing service agreement ever again because I just didn't feel good about that. I'm not supposed to be financially incentivized, even in a roundabout under the table way, for anyone to be like pushing you to go to one mortgage lender over the other. I don't currently have any of those with any lender. So even if you were to come and ask me after this class who I would recommend, none of these people that I'm sending you to are paying for any of my marketing. And so it is possible that I could enter into, theoretically, I could enter into one of these agreements at a future date, theoretically. So just keep that in mind, and keep that in mind when you're choosing a realtor, right? If they only give you one name, it doesn't mean that that person might not be the best deal for you, but at the same token, if they're only giving you one name, they might be in this marketing service agreement and they might not be the best deal for you. So just keep that in mind. Those are my conflicts of interest that I wanted to disclose before I went into the presentation. Does anyone have any questions about this? Okay. All right. So now we'll get into the presentation. So before I can teach you how to shop around for a mortgage, you have to understand what the costs of a mortgage are. So there are two different kinds of costs when you obtain a mortgage. There's your long-term costs. Most people know what that is. It's your interest rate. You're making payments to the bank over the life of the loan, and that's dependent on what interest rate you choose or you lock in when you find a mortgage. What a lot of people is a lot more ambiguous and they don't quite understand is the short-term costs, which are the loan closing costs that are due at closing. So on top of you paying the bank hundreds of dollars of interest a month for your long-term mortgage costs, you also have short-term mortgage costs. And I'm going to go into what those are this next slide. So if you've been to my first time home buyer class, you'll probably recognize this slide. This is what the mortgage loan closing costs are when you're trying to obtain financing. So there's the loan origination fee. This is your commission for your mortgage loan officer. And we're going to talk about this a little bit more in the next slide. Um, you have an underwriting fee that's paying the bank, the person at the bank who is approving your paperwork and your loan and making sure that you're going to be a good investment. That's their fee for doing all of that. There's processing, that's just kind of the paperwork fee. Then there's also a recording fee with the county. With the county recording fee, that is just recording the deed publicly. And so it's constructive notice that the home is yours. So that's included in your closing costs. You have to pay an appraisal. If you're going to get a mortgage loan, you have to pay for an appraisal. The lender requires it, the lender orders it, and they pick the appraisal company that does that. That's one of your costs that you'll have to do. You have title insurance. So also part of my first time homebuyer class, I kind of explained what title is. Um, title is home title is just like car title. You want to make sure that it's a clean title. You want to make sure that there's no liens or encumbrances on the property. And if there are, you want to go into it knowing that it's okay. You want to make sure that the seller doesn't have any judgments on their side of the deal, because if the seller has judgments on their side, then they might not be able to sell you the home if they have to pay off their judgments. So title does all of that kind of stuff and does that research for you. Then you have to get your credit score pulled, unless you're like using a Dave Ramsey lender, which they don't do physician loans. Then most of them will check your credit scores. And I talked about more of how they do that in my first time home buyer class. They pull all three of your credit scores, your Equifax, TransUnion, and your Experian scores, and they will take the middle score as your loan qualification score. And then there's escrow. Escrow is essentially your savings account for your taxes, your home insurance. They collect a bunch of it up front. So, and then you pay over, as part of your mortgage payment, you pay your home insurance and your taxes to the lender. They save it in a bank account for you essentially, and they pay it for you. They need to have a buffer for that account just in case your taxes go up or your insurance goes up. And so they collect that buffer called escrow at closing as part of your loan closing costs. So we're going to talk about a little bit more about this first one, the loan origination fee. So the loan origination fee is your mortgage loan officer's commission. So your mortgage loan officer's commission is the single largest portion of your loan closing costs. It's usually anywhere from 2 to 5% of your loan amount. So not the purchase price, but your loan amount. So the more money you put down on a loan, the less the loan officer's commission is going to be. Not that that makes a huge difference, but their commission is calculated off of your loan amount. So it's usually anywhere from 2 to 5% of your loan amount. So I'm going to show you on this next slide the difference that shopping around can make. So say you go with loan officer one, you go get a quote. There's all of these fees that I told you about earlier. And if you're comparing to this loan officer two, most of these fees are going to be pretty similar. Title is going to be the same no matter where you go. You get to choose your title company, or your realtor will recommend you to a title company. Title company prices are public, just like gas prices. So they're constantly trying to compete. So your title, no matter what, like this fee is going to be the same. Your escrow is going to be essentially the same. Credit report fee is not more than, it's in the $50 to $100 range. It's not that big of a deal. But sometimes one place might have a little bit higher of an underwriting fee, or another place might have a little bit higher of a processing fee. But the thing that dwarfs all of these costs combined is the mortgage loan officer's commission. So if you were shopping around and you found someone who had a 4% origination fee, like their costs are almost like $5,500 more than this person's costs, even though like some of these costs are higher, because this person's charging a 2% origination fee, this person's charging a 4% origination fee. Now, wouldn't it be nice if it looked like this when you were shopping around for a mortgage? It would be really easy to make a decision if they presented you a quote and they said, here's what our fees are. And you would just look at it and be like, okay, this is simple. Like, this guy is obviously better. But unfortunately, it doesn't look like this at all. It looks more like this. It looks like a bunch of numbers and a fee worksheet that everyone has different numbers. Like, this person looks like they have extra stuff. This person isn't calculating some stuff into it. So it's really hard to try to compare quotes when they look so different. They don't look like this, they look like this, right? So my job as this class tonight is to try to teach you how to translate this into something that's easier to understand like this. So when you shop around, you can a whole lot better decipher which one is looking like a better deal for yourself. So you don't have to have someone tell you. I'm just going to show you a little bit closer up what these worksheets look like. So this is something called the fee worksheet. When you're shopping around for a mortgage, this is the thing that you will want to ask for when you're shopping around. To get a fee worksheet, you do not have to give them, you don't have to let them pull your credit score. You don't have to let them see any of your income or assets or send them any paperwork. And I'm going to give you a formula that will tell you exactly what to give them and what to ask for, and they'll just pump it right back out to you. So this fee worksheet is what you'll be using and looking at. It'll look similar to something like this when you're shopping around. The important thing I want to point out with this fee worksheet is there's no obligation when they give you a fee worksheet for them to actually, like, there's nothing you sign to agree that this is going to be the price they are giving you. It's just kind of a quote. So what you do is you should shop around for all these fee worksheets. I'm going to give you the criteria to help make this easier to decipher and to compare quotes. And what you do after you've found the one with the best fee worksheet is then you go through a mortgage application with them, let them pull your credit, and then you ask for a loan estimate. This is what a loan estimate looks like. This is a government mandated form that essentially makes loan officers stick to their word as close as possible. So when you start to originate a loan, when you found a house, then what you do is they're going to send you this loan estimate. And then what your job is to make sure that when you sign this loan estimate, that it's coming close to what they said. Now, I have to let you know that mortgage interest rates are just like gas. They'll change every day, sometimes up, sometimes down. So it might not be exactly what they said, but it should be pretty darn close. And if for whatever reason you're kind of saying, hey, what you said right here is totally off from what you're telling me in here, don't sign it until they can change it to make it look more like that. And if you still don't feel comfortable about it, shop around more, go back to those other ones to see if that is the best thing for you. Mortgage loan officers are kept to tolerances. So for example, services that you cannot shop for, like these services, when disclosed, there's 100% tolerance. These numbers cannot change. If these numbers were to increase later on, it would come out of the mortgage loan officer's commission. Services you can shop for, there's a 10% tolerance. So the pest inspection fee, if you did that and they were including that in your mortgage loan closing costs, this $135, it couldn't increase more than $13.05. And if it did any more than that, it would come out of your loan officer's commission. So that's why it's important to shop around, get these fee worksheets, but then also make sure that your loan estimate matches up to that. Does anyone have any questions so far? Okay. All right. So this is something that I want to point out. So,
sorry, Katie, I
yeah,
do.
no, go ahead. No, go
I'm
ahead.
so sorry. I couldn't find my unmute.
No, you're fine.
So I was kind of holding off. We have two mortgage companies that we're working with. They've sent us paperwork, and now that I'm listening to this, they're both like, have you filled it out? Have you filled out the application yet?
Uh-huh.
So if I understand what you're saying, and I was hoping for this class before I did anything, is that I can request the mortgage fees. Is that what the first sheet that you
Yeah,
showed us
the
was?
fee worksheet. Uh-huh.
Fee worksheet.
Yes. You could request a fee worksheet, or if you've already given them all your paperwork and they can
We
give you a
haven't.
loan. So yeah, if you haven't given them all your paperwork yet, you don't have to. And I'm going to talk a little bit more about
Okay.
what you can give them to get this fee worksheet. So then you're not giving your social security card and your bank statements and your W-2s to like
Yeah.
50 different people, which is a ton of work. So
That's what I'm hoping for. So that's what I'm looking for, because we're kind of sitting on them right now, and they're sending me like, hey, have you
hey,
done it? But I
sign
was
this.
kind of,
Mhm.
yes, but I was waiting for your class. So
Yes. Yeah, that's the very next slide. I think it's coming up. So
I have a
and
question.
yes, go ahead.
Sorry. So when you look at a loan, I I thought that there was like an interest rate that you looked at, and then there was like an effective interest rate that rolled in closing costs so that you could compare apples to apples between loans. Is that the case, or am I off?
So no, you're right. It's the APR. That's what, so you have like your interest rate, and then on page 3 of your loan estimate, there's the APR, which you can compare. But the thing is people can manipulate the APR to make theirs look better up front, and then it's not as good, because you're right, that's what the APR does. The APR kind of helps to calculate in the closing costs, but the best APR is not always the best loan. And I'll show you kind of why. Let me see. Yeah, so it's going to be on one of these next slides. But yeah, APR is also something to take into account when you are shopping for a mortgage.
Cool. Thank you.
Cool. Any other questions? All right. And just so you know, this loan estimate, if you sign it, it's not obligating you to use that person. With a mortgage, you can switch all, like choose a different lender. You can sign all the paperwork. You can do all this process, and all the way up until you sign the final paperwork and it records at the county, you can actually like switch lenders or not use them. So just because you sign a loan estimate doesn't mean that you can't go somewhere else. All it means is that you've locked in their initial bid, to now they have to keep to that word by certain tolerances. Okay, so I've kind of shown you a loan estimate, a fee worksheet, and now you're probably thinking like, okay, what does this really mean? How can I actually compare? How can I find the common denominator? How do I figure out the people who have the higher origination fee, the higher closing costs? And so this is if you don't understand anything from this class, this is the most important slide. I have people who I offer my clients to take this class, and they just say, no, I don't really want to take the class. Just tell me what to ask people for. This is essentially what I send to them. So if you don't understand anything else out of this class, this is what I would take out of it. This is how you get a fee worksheet. This is the information that is going to be required to get a fee worksheet that's going to get everyone on the same common denominator. So then you can compare apples to apples, and then you'll figure out by the numerator, which is the cash to close and APR. So just like they were saying, when you look at the lowest cash to close and APR, that's usually what wins. Whoever has that, once you get all of these apples to apples. So what you'll need to do is the most accurate way to do it is to have, like, if you didn't want to have one lender pull your credit, you could go to freecreditreport.com and pull a free credit report that doesn't ding your credit. You could look at your 3 credit scores from the 3 bureaus. You would pick the middle score. So if you had an 800 credit score, a 790, and a 780, you would say, okay, 780 or 790 would be the middle score. And so you would say, okay, I'm going to tell them that my estimated credit score is 790, or in this case, I put 700. What you could also do is you could get on your credit card company and you could look at, like, if you have Credit Karma, and see what the number looks like. For the purpose of getting quotes, it doesn't have to be exact, because you're just trying to get the common denominators and the numerators. And if any of those numbers are going to change, they're going to change across all the lenders. So for the purpose of just getting quotes, you want to make sure that they are all giving you the same rate. They're all going to give you the same rate from the same day, because, like I said, rates change multiple times a day potentially, and they are different on different days. So you want to ask them to give you their best rate from the same day. You want to give them all the same purchase price. You want to give them all the same down payment. So if you're trying to do a 0% down professional mortgage, you would say, we're not planning on putting any money down, because that affects the interest rate. You'll want to ask them to do monthly mortgage insurance. Now, if you're getting a true physician loan, you're not going to have any mortgage insurance. It's not even going to be lender paid. Now, what lender paid means is, what they do is they essentially make you pay your mortgage insurance in one big lump sum, either in the form of increasing your closing costs or wrapping it into your interest rate and increasing your rate a little bit. True physician loan lenders don't do that. They don't make you pay your mortgage insurance as part of your closing costs up front, and they also won't increase your rate by doing a lender paid mortgage insurance policy. So if you're shopping around for a physician loan or a professional loan and they quote you for mortgage insurance at all, then it's probably not the best kind of physician loan out there. Everyone's going to claim that they do a professional loan or a physician loan, and in their eyes, they probably do. They probably say, oh, well, we're going to knock off origination fee $500 and we're going to do a lender paid policy. So there's no mortgage insurance and it's cheaper. But the true physician loan lenders out there don't have this. So when you're shopping around, it's good to at least ask, because then they can respond to you and you can say, okay, like, should I use this person? Does this look like it's a true physician loan? So you'll want to ask them to do a monthly mortgage insurance plan, not the lender paid wrapped in. Because if you don't specify this, then they're just going to be like, oh, I'll just wrap in the mortgage insurance and give them this rate. Even if they did that, it's going to show in like their closing costs are going to be higher. So you'll be fine there. Per diem interest, I can explain that if you want me to. It's essentially just saying, from the time that your loan closes to your first payment, depending on the day you close, you're going to have to pay a daily interest charge. It's called per diem interest. And that's just estimated at halfway through the month, 15 days. What I have seen some lenders try to do to try to make their APR look a little bit better is they will decrease their, when like one person will quote you at a 15 days. And even if you ask them to do 15 days, someone to try to artificially make their APR look lower or their cash to close lower, they will give you a quote with 1 day on it, which isn't comparing apples to apples, which is why it's good to go through and check these things when you get a quote from a lender. Then you give them taxes. You just give them all the same number. It doesn't really matter what the number is. For example, I estimated taxes at $200 a month. Now, if you're buying in Texas or if you're on the East Coast, that's not going to be a realistic number. So if you're looking at a specific house and you can even get on Zillow and look at what the taxes were, then you can tell them like, okay, for this specific house, we're looking, or you can ask your realtor if you're working with a realtor, you can say, okay, taxes are looking like it's estimated about this a month. Give everyone that same number. Home insurance, it's looking like this. Give everyone that same number, give everyone the same credit score, and tell them that you're not looking at getting any closing costs from the seller. And like I said, if any of these numbers change later on, so say that you got a quote for $0 in seller paid closing costs, but when you actually get a home, you get $3,000. Well, if these guys were the lowest rate and lowest cash to close and lowest APR before you had closing costs, they're going to be even better after that. If your credit score gets better with the lender, then their interest rates should get better. Depending, like most lenders, their credit score caps out at 740. is what the best rate you can get. So someone has a 740 credit score versus someone who has 810 credit score, most of the time your rate's not going to be better. It's all kind of gravy after 740. So like I said, if you're shopping around for a mortgage, you don't want to do the application process. You don't want to go through all of these things. If you get these numbers to be the same, like for example, also, and you just want to make sure that some of the other numbers are the same too. Like if you're living in Louisiana and they require flood insurance, maybe someone was going to quote you for like $1,200 a year for the flood insurance, and another person on their quote is saying we're only going to give you like 600. Then you would make all of them, you would just add that to all of the cash to close numbers, which I'll show you. So here on the loan estimate, the cash to close is right here. And here on the fee worksheet, the cash to from borrower is right here. You'll also want to make sure that some people might be including your down payment into this, because closing costs are not going to be $52,000. So this person is calculating in their down payment into the estimated cash to close. So it looks like the purchase price was 800 here. The total, the purchase price is 800,000. It looks like they were doing 5% down, so they needed 40,000 for their, because the loan amount was 760, purchase price was 800,000. So then they're in this quote, they're calculating that they've put a $40,000 down payment. So then you would just say, oh, okay, well, if we subtract the down payment from this number, now we're at $12,182 in what our closing costs are, our cash to close. So you'll just want to make sure that when you get these fee worksheets or the loan estimates, that the numbers are the same and they add up. And this is the most important thing. These things are the things that are universal, no matter what state you are in. These are the biggest things that you're going to be looking for when getting a quote. And if there are any other things that are state specific, I think just by understanding this principle, you'll be able to kind of extrapolate if you need to add something here or there. But this just helps to get you as close to the common denominator as possible. Does anyone have questions about this?
I have a question. I was just, where you've got specific rate from the same day, but you said that the rates can change day by day. And I know it's one of the things we're comparing between lenders. So on the right side, you had given them a 3.75% rate from this day. Do you give them a number, or do you just say like the day?
So what I would do is you want everyone to be giving you the exact same rate. Because if you don't, and I'm going to explain kind of how interest rates and closing costs are intertwined in a couple slides. And so you'll kind of understand this a little bit better, but you got to get, so yeah, you will ask them to give you a certain rate. And what you can do is if you get a quote from one person first, if you didn't want to just send this out to everyone all at once, if you already have a quote from some person, you can just take their rate and say, okay, their rate was 3.75%. Give me that rate for yours. This is what my purchase price is going to be. My down payment is going to be 3%. This is what I gave the other guy for my credit score. And make sure, and then you could always do it that way too. You could take someone else's quote and just line up these specific things, and then line up those specific things and then get another quote. Or you could just flat out from everyone say, I need this rate. Now, it's good to talk to, if you're working with a realtor, if you don't know what the rates kind of are at, right? Because if you were to come to a loan officer right now and ask for a 4% interest rate, no one's going to give you a quote for that because they're not even really offering that right now because rates are so low. Or if you go too low, then it might look like the costs are higher. Right now rates are in the high 2s, low 3s, depending on where you go and what kind of product you get, even into the low 2s, depending if you do a fixed rate mortgage or adjustable rate mortgage. So, but the principle is, you just ask them for a certain rate from that day. And the loan officer will go back and extrapolate, and they're going to look if the rates had changed multiple times that day. They're going to give you the best rate from that day. Does that make sense?
I guess that's the part that I'm confused by. If they're going to give me the best rate from that day, but I'm specifying the rate, then am I not giving them the flexibility?
No. So, I will explain. So when I say the best rate, they're going to give you the 3.75% rate, but they're going to give you the 3.75% rate, but whichever one had the best amount of closing costs tied to it. I'll jump ahead just a couple slides to kind of show you. And I'll go into more detail about this in just a little bit. So these are the interest rates for the day. This is called a rate sheet. This is what we look at as mortgage loan officers when we're trying to determine what kind of rate we can get you and what your closing costs are going to be. So for example, at this 3.375% rate, anything that's in parentheses means it's a credit to you. Anything that is not in parentheses means that this rate is so darn good, it's going to cost you extra closing costs to get that. So when rates change multiple times a day, what that might mean is if you ask them for a 3.375% interest rate on that day, maybe in the morning this number is 213, but maybe in the afternoon rates got better. If rates got better, maybe now they're going to give you $300 in closing costs for that rate. When rates get better or worse, all it really means is that the amount of credit that they're willing to give you to help pay for your closing costs for that rate, either you get more money or less money. Does that make sense?
That does make sense. That's super helpful. Thank you.
Okay, cool. Yeah, I kind of jumped ahead a little bit there, so sorry if I give anyone a headache, but that's kind of so to understand that. That's why you're asking for a specific rate from a specific day. And if the loan officer, if their rates changed at their bank multiple times during that day, they're just going to give you what their best rate was from that day. Any other questions on this at the moment?
Yeah, I've got a question.
Uh-huh.
You were talking about the mortgage insurance and some of them being rolled in and kind of hidden. How would, if they were hidden in the cost, like how would I be able to extrapolate that out if it wasn't just said, hey, this is rolled into your loan?
So that is my very last slide. And it's the way you will see it is that your either interest rate will be higher or your closing costs will be through the roof. Because if they're going to be rolling in the monthly mortgage insurance into your interest rate, if they can't pay through the interest rate, if you're forcing them to give you this rate, then they're either going to have to increase your closing costs to cover all of that money, or they're going to just say, oh, sorry, I can't give you that rate that you're asking for. I got to give you a higher rate. And the last slide that I have in this presentation hopefully will illustrate that a little bit better. So circle back to me at the end. If I haven't answered that question, if it doesn't make crystal clear sense, then I'll explain it a little bit more.
Okay, sounds good, thanks.
Cool. Any other questions? Okay. So like I said, this is probably the most important thing that you could take from this class. If you don't take anything, this is going to be your best shot at getting the fee worksheets all put together and helping you to extrapolate the data a little bit better and finding the common denominator. So if you use that formula that I kind of gave you from the previous slide to get your quotes, it's going to dramatically increase your chances of understanding who has the larger origination fee, because that will be shown in the closing costs. This is going to make a little bit more sense as I go back to that, how our rate sheets work as mortgage loan officers and how the closing costs and the interest rate are intertwined. A lot of people will say that like you can get the seller to pay for closing costs or you can get the lender to pay for closing costs. At the end of the day, it's always you. you are always paying for your loan closing costs. They're just structured in 3 different ways. So the 3 different ways that you can pay for your loan closing costs are you can pay it from your bank account. So this isn't a common option for a lot of people. Most people can barely save up for a down payment, unless if you're a first time home buyer, especially. And so a lot of people don't have their down payment and tens of thousands of dollars in extra costs to cover all of those loan closing costs, your loan officer commission, all of those closing costs that we talked about. So this isn't super common, but some people do it. The other way that you can pay for loan closing costs is you can ask the seller when you're negotiating a purchase contract to pay for seller concessions or for some of your closing costs. And you can negotiate that into your purchase contract. Now, across the United States right now, this is not common. There's a big, huge housing shortage in most of the United States. There's a huge housing frenzy. It's a seller's market. Pretty much any realtor that I've talked to all across the United States, these are not really existent right now. To be competitive, you cannot ask for the seller to pay for loan closing costs. A year ago, I was still getting closing costs. It's very rare for me to be able to get this right now. I'm probably in one of the hottest markets there is right now, though. I'm in Salt Lake City, Utah. So this is not a thing right now to help pay for closing costs. So if you're thinking about buying a home, I wouldn't bank on this. You could try for it, but I wouldn't count on it. So then that leaves you, if you're like, okay, well, if I can't get the seller to pay my closing costs, I barely have enough money for a down payment. Or if you're doing 0 down and you literally have no money for a down payment, and now you have to try to figure out how to pay for closing costs. The third way that you can pay for your loan closing costs is the bank will pay for them. The lender, and they'll do that by increasing your rate. So now we're going to go back to this this rate sheet that I was explaining before. So this is a rate sheet. It's not public. Most lenders will not show you this. This is proprietary information that the bank has. So if you were to come to me with a loan application and say, hey, I just got under contract on a home, or I'm thinking about getting under contract on a home, and it's going to be $300,000. And say I'm a mortgage loan originator who's only charging a 2% mortgage loan origination fee, which you'll figure out who's charging the higher rate from who's charging like more of an origination fee from that cash to close or the APR, when you get all the apples to apples and you're not comparing all those different numbers to each other. So the total closing costs for a $300,000 home, if you're doing a 2% origination fee, depending on where you're at in the United States, it's going to be about $12,000. Now, a loan officer is never going to tell you that they're never going to tell you that your closing costs are $12,000, or your eyes would bug out and you would say, man, I can't afford a home, and no one would do it. So to soften the blow, we hide them. We hide your loan closing costs in your rate sheet. And so I'm using this as just kind of an example. $300,000, say you have $12,000 loan origination fee with all your closing costs, and say you were lucky and this was 2 years ago and you got $6,000 in seller paid closing costs to help to cover for $12,000. So now we have to find another $6,000 to cover elsewhere. This is what I'm thinking. This is literally what goes through my head as your mortgage loan officer when you come to me and you say, hey, I want to get a mortgage with you. This is kind of my situation. I don't have any money in my bank account to pay for closing costs. Hey, but I got the seller to pay for $6,000 of them. I got to find the money elsewhere. If I can't get it from you, I got to figure out a way for the bank to pay them for you. So I'm sitting behind my desk and I'm saying, okay, they don't have any money in their bank account. So I gotta they have like maybe a little bit of money that they can bring to closing costs. I got $6,000 from the seller. I got to figure out a way to cover $6,000 of their closing costs. So then what I do is I come to this rate sheet where I have my interest rates and then I have my dollar amounts. Now, remember, as I was explaining earlier, if the interest rate right here does not have parentheses, it means it's such a good rate that not only are they not going to give you any credit to help you pay for your closing costs, they're going to make you pay extra closing costs to get that rate. So if you were to pick this 3.25% interest rate, that the closing cost charge is $1,365. Now your total closing costs would be $13,365. Right? So they would just add that to your closing costs because that rate is so dang good. If I'm your loan officer and I'm trying to figure out, like I said, you don't have any cash, I'm going to go to this rate sheet and I'm going to say, okay, $12,000. I got $6,000 from the seller. I got to find $6,000 somewhere. So I'll go do. Oh, and I'll look and I'll say, okay, that one looks like it's giving me too much. Looks like I could do this one. This one looks like it would cover most of it. So then I would say, okay, looks like I can get you a 3.75% interest rate, and it looks like your closing costs are going to be around $300. That's a lot more easier to take in and to swallow than me saying your closing costs are really $12,000. But hey, if I raise your interest rate from this one to this one, then you only have to pay $300, right? This is kind of what we do as mortgage loan officers. When you hear something called par rate in our mortgage loan officers kind of slang, what we say, what par rate is it's saying, what is the closest rate to $0? What is the rate that is not really going to give you a whole lot of credit, but is not going to cost a ton? So in this situation on this fee worksheet, par rate is going to be this $213 credit, which would essentially mean your closing costs are still about $12,000. If you wanted this lower rate, if you didn't want the lender to cover a bunch of your closing costs and you wanted the lower rate, then you could pick this 3.375% rate or par rate, and then which would mean the lender would only help you pay for $213 of the remainder of the $6,000 of closing costs, which would mean that you would have to bring in $5,786.25 out of your pocket if you chose this lower rate. Now, this is where the origination fee comes back in. If someone has a higher origination fee and now this cost is $16,000 because they're charging a 4% origination fee versus a 2%. Now they're to be able to still give you that good number, that happy number where you're like, holy cow, like I don't want to pay more than a couple $1,000s out of my pocket in closing costs. They're going to have to pick a higher rate. So if you went with a lender that one of two things could happen. They could be financially incentivized to upsell you this rate to the 4%. Because I mean, if they're only charging you a 2% origination, but they could get you to get this higher rate, then they get a bonus. They get whatever the remainder of the bonus is. Or if they're just charging a higher origination fee up front, and this number is now, if this number instead of being $12,000 is like $15,000, then they're just gonna, like, if they want to get you that like $300 number that would have been the same if you would have picked this rate with the lower origination fee, they're going to have to get you a higher rate to help cover all of that cost, that extra cost for their commission. So the 4% rate would cover all of your closing costs in this situation, all the remainder from after what the seller paid. But now they're either going to be getting a bonus for selling you the higher rate, or they just had a higher origination fee to start off with anyway. So that's why it's important to get everyone on the same page when you get a quote for your interest rates, to make sure that they're not just like wrapping it into the rate and kind of trying to hide their origination fee from you. If you force everyone to give you the same one, then their cash to close amount is going to increase to or decrease to what it will be easier to compare across the board. Does this make sense? Does anyone have questions about this? This can be kind of confusing.
I have a quick
Sorry,
question. So is this what they're talking about when they say that I paid 2 points down on to get a lower interest rate? They're just paying more money in the closing costs?
Yes, you're paying points. You're paying more money in your closing costs to get the interest rate down. You're buying down the rate. You're paying points.
Okay.
Yes.
And if you change the rate later, the origination fee and stuff isn't going to change also?
The origination fee is a percentage off of what your loan amount is. So if you were to change the interest rate, and that's why it's and it depends on the lender. Maybe they might change their origination fee if you decide to change the rate later. That's why, like, before, I usually recommend, like, the day that you want to pick someone, like, that you say, oh man, like, this is the place I'm gonna go. You reach out to everyone and get quotes, and you can do this multiple times. You can send that formula to the lenders and just double check multiple times until you finally said, okay, this is what I want. I'm going to go with this. We're going to lock it in. Because they could change their origination fee. I've had a company that I've worked with that was charging like a 2.5% origination fee. And then overnight, the bank decided, oh, we're going to start charging 2.75%. So until it's time to lock in your interest rate, so like sign all the paperwork and they say, we're going to lock your rate, that's when I would make sure you would get a quote that day as well. If you really wanted to make sure that their rate hadn't changed and it still was the best. Does that make sense?
I guess what I'm asking is, so you're giving them the same numbers to all of them to make sure, to find out who's giving you the best deal. And I'm just asking, that's not going to change if you change the rate or something. You'll still be getting the best deal by whoever.
Yeah, usually not, because you're trying to figure out what their origination fee is, because that's the biggest cost, right? And so if you found someone with the lowest origination fee, and all origination fees are based off of percentage points of, like, 2% versus 5%. If you found someone with a 2% origination fee and their rate is 3.375%, and then you were to go up to the 3.625%, they're still charging you a 2% origination fee. So they're still going to be better than the guy who's charging you the 5% origination fee, even if you change the rate with them too. So in principle, yes. In practice, they could change their origination fee. And that's why the loan estimate is important, because if you get the loan estimate, they can't change their fee like that anymore. So sometimes, like, if you've narrowed it down to like 1 or 2 fee worksheets, and then you're just like, okay, one of these seems like it's the best, they're just absolutely creaming everyone. No one's going to change their origination fee by over 1% overnight, right? They're not going to increase it by that much, if they increase it at all. And so then you can compare the loan estimates from those 2 people once you've narrowed it down, so you're not giving your information to everyone else. And then the loan estimate is going to keep them to that word, so then they can't increase or decrease their origination fee. I don't know if that's super helpful, but because some lenders are different, right? But in general practice, the price that they give you one day is going to be their origination fee, no matter what the rate is.
Hey, Kate.
Yes.
So how do is there a way for us, as someone who's buying a home, like in this situation that you have up right now, how are we gonna know if they've moved us up to 4% to get the bonus?
So
like, how do I know that they're not just moving me up higher to get more money when I could be a couple points lower?
Yeah, and that's the hard thing, is you can always ask them to show you this rate sheet if you want. Most of them are going to say no. But what you do is you tell them you're shopping around. If you give them this information and you're using this language like, hey, I want monthly mortgage insurance, not lender paid mortgage insurance. I want daily per diem interest. They're going to know that you're an educated mortgage shopper, because you're using terminology that normal people don't usually use. So they're not going, if they know you're shopping around, they're going to try to give you their rock bottom rate from day one, right? They're not going to try to upsell you, because they know if you're shopping around, and if you tell them you're shopping around, they're not going to want to do that. If you don't tell them you're shopping around, then they might say, oh, this is a doctor, or this is this is a dentist, or this is or a pharmacist. They make lots of money. Let's try to upsell them. Most of the physician loan lenders that I work with, you'll go to them and they'll just give you the rate. They'll say, this is par rate. This is what our par rate is. This is what our closing costs look like. And they're really trying to fight for professional. Like, I'm a little more concerned about that in the not professional loan market, them trying to mark up the rate. But man, these physician loan lenders, they are just clawing and fighting to get your business because of the interest that they can make off of you in the long run. And most of them require you to open a bank account with them and deposit a little bit of money. So they're in it for the long-term game. Most physician loan lenders are in the high twos right now, like low threes maybe, depending on how much you have down or if you're doing an adjustable rate versus a fixed rate. But yeah, that's the hard thing is you don't know if they're going to be upselling you. The only way you know is if you're comparing to someone else. And if you compare it to someone else and someone else is still better, even if they're upselling you, if you're getting a better rate than the other guy, then it's still a better deal.
Okay, so then are we allowed to ask what the par rate is?
Yes. Yeah.
Okay.
So you are totally allowed to ask, what's your par rate? So you could ask what's their par rate. And you could even ask them to see if they would show you their rate sheet. Most of the time they'll say no because it's proprietary. I know some non-physician loan lenders that are called full disclosure brokerages that will show you their rate sheets, and they'll essentially go through this just like I did with you, and they will let you pick your rate. That's the brokerage that where I used to broker with. I would do this with my clients when I would help them get a mortgage. I would sit down, show them the rate sheet, do the education. I would let them pick their rate. And I'd say my origination fee is the same no matter what rate you pick. The cost is going to be the same. You decide what to do. They're called full disclosure brokerages, but I haven't met a single physician loan lender yet that will do that. So that's when we just go back to the, if you can't see this, which you can't see this, what this formula is essentially doing for you is it's extrapolating backwards from what they've been doing here, behind the scenes, because they're going to give you a cash to close number on this, because your cash to close number on this rate is going to be higher than the other one. Then your cash to close on this rate, because it's a lower rate, is going to be higher. And so that's going to show up in your cash to close estimate. So if they're trying to upsell or downsell you a rate, if you're comparing apples to apples, then you're going to be able to tell, by the cash to close which one of the people are trying to upsell you the rate, because it will show in their cash to close if they're all giving you the same rate. Does that make sense?
Yeah, thanks.
Sorry, this is something that my first year as a mortgage loan officer, I didn't even quite understand. And so I also have a explanation sheet that takes everything that I just said here and it kind of explains it in detail again, because sometimes it takes multiple times to kind of understand how this works. I have a sheet that kind of explains that I can send to you. But at the end of the day, if you do this, it's going to help you it's going to help to uncover all of the stuff that was wrapped in to all of this stuff. This stuff is complicated. This is just more for if you're trying to understand how it all works and how I figure it out, or how mortgage loan officers figure it out. This is how we do it, but the result always ends up coming out in the cash to close if you have everyone giving you the same rate. Does anyone have any questions? Okay. So this is the last slide. This is what I was talking about with, this is how there's a difference in professional loan financing and like traditional financing. So on a traditional loan, I'll start off with the professional loan over here. So say you go get a quote for a professional loan and they're going to give you a 2.375% interest rate. And they're going to give you $1,374 in help for your closing costs for this rate. Your principal and interest is going to be $2,331 according to what their criteria was for this loan. This is your mortgage insurance, your MI. So this is a low rate. You're getting that amount of closing costs, and there's no mortgage insurance involved at all. There's no mortgage insurance. So your payment with a professional loan is looking like this, $2,331. Now, if you were to go to a non-physician loan and go for a rate, they might give you the 2.375% rate there. You're already, $3,000 off. This one was giving you a $1,300 credit. This one, they would charge you 2.331 or $2,331.92 for this rate. So physician loans are usually have lower rates, just lower rates without even factoring in mortgage insurance. And they don't have this mortgage insurance number right here, this like $250 a month. So by finding out who are the physician loans versus who are not the physician loans, it can save you quite a bit. Like in this situation, it saved $328 a month and over $28,000 in interest. So to go back to well, how do I figure out which one is charging me mortgage insurance and is wrapping it into the rate and which one isn't? So in this situation, say ignore this $250 number right here. Ignore that. So a lot of the times this 2.375% rate, if you were doing the monthly mortgage insurance, it might be the same. So this 2.375% rate, it might be $1,374. And then they might have $250 a month in mortgage insurance payment. So if you're comparing those apples to apples, like if that was the situation, if a lender wanted to get rid of this $250 a month number to try to make it seem like they didn't have mortgage insurance and they were, going to give you the same rate as that one, they would just say, okay, you have $250 a month in mortgage insurance for a 2.375% rate. What I want to do is I want to make it seem like there isn't any mortgage insurance. So I'm going to look at these. What I'm going to do is I'm going to look at these principal payments, and I'm going to increase your principal payment by $250 from this number. So 2,331.92. So you would add 250 to that, and you'd say, okay, well, so this mortgage payment was 2,331. I need to find one that's closer to 2,500 or 2,570 to cover this if I'm going to get rid of this. So now they would add that 250 and they would go closer and they would say, okay, 2,331 plus 250. We're looking like we're in the 550 range. So I'm going to give them, maybe a 3% rate versus the 2.375. And that's how they would wrap in the mortgage insurance, is they would wrap it into your rate. And a lot of the times they will actually give you a little bit of a deal. They won't charge you the full 250 by increasing your principal by choosing the higher rate. Because if you choose the higher rate and if you never refinance, and you do the lender paid mortgage insurance, and so you technically don't have mortgage insurance, if you kept that rate throughout the whole life of the loan, they would make more money off of you in the long run. Since usually if you have a monthly mortgage insurance payment, they drop that off once you hit 20% equity. If you don't have a mortgage insurance payment at all, you buy it out by getting the higher interest rate up here, as they're just wrapping it into the principal by choosing the higher rate. If you continue to have that higher rate over the whole life of the loan, they've just made money. So that seems like a pretty dramatic jump from 2.375 to 3%, but it's usually not that high. It's usually more like 2.875. Your monthly payment's usually a little bit lower if you were to choose to do the the wrapped in mortgage insurance option versus the monthly, because they're banking on you keeping that higher rate for the whole 15 years that you would choose. I usually don't go into that a whole lot in this specific class because most physician mortgages, and I'm going to give you resources. Like I can tell you, like for example, I can tell you this one off the top of my head. On the physician finance page, they have like a website where they say, here are some physician loans. And those are usually the vetted physician loans that aren't wrapping in the mortgage insurance. So you don't even have to worry about that whole scenario that I just taught to you. They've already been vetted that they don't have mortgage insurance and it's not wrapped into the rate. White Coat Investor is another one that they'll put the actual physician loans on their site. Now they are paid to put those, like the people who put their names on the website are advertising to put it on, but it's a great place to start to shop for physician loans, since not all lenders do physician loans in every state. So if that was confusing to you guys at all, it's not something you really need to understand about the mortgage insurance, just because it's not going to be super pertinent to us as professionals, you know, doctors, dentists, pharmacists, because if you go to the right resources to get you on the right track up front, or you talk to your colleagues about who they used, then you won't have to worry about extrapolating that. It's kind of complicated. So any questions? That's essentially the end of the presentation. Like I said, that one slide, if this is all going completely over your head and you feel overwhelmed, like I said, this took me years to understand as a mortgage loan officer. And a lot of the times I'll teach this class and some people will be like, okay, I don't really understand quite everything that you said. But at the end of the day, if you just take one thing out, is try to do this, find the common denominator, try to see who has the lowest cash to close and lowest APR. And if you ever have any questions, then you can totally message me and say, hey, I'm kind of confused here. One person's telling me this, another person's telling me that. And if I have time, I can kind of take a look. So does anyone have any questions?
Kate, I have a question.
Uh-huh.
So if the, you said that on that last slide, you said the mortgage insurance and things will drop off when you hit 20% equity.
Mhm.
Does that mean if you are planning on doing like a 20% down payment, that there won't be much difference between traditional and professional loan?
What would happen is you would actually get an even lower rate for a professional loan. So for example, there was a client that I was helping to, in this exact same situation, they were trying to decide if they wanted to do 10% down or if they wanted to do 20% down. The rate that they were quoted for the 10% down was right around 2.5% if they put 10% down with the physician loan lender. And then when they decided to do the 20% down, that rate actually dropped all the way down to 3.325 or 2.325. So it still made that physician loan rate even better. And usually physician loan interest rates start at a lower base than the traditional financing. So most of the time, physician loans are still a better deal, even if you do have 20% down. But it's always good to shop around. They're like, and this physician loans aren't for everyone. Sometimes VA loans, if you're a veteran, VA loans can be just as good or better than physician loan mortgages. I've actually had someone who was a teacher, and they shopped around to like 20 or 30 different places, and they shopped around for teacher loans and for physician loans. And I gave them this presentation and they did that shopping around, and they actually found like a teacher loan that was better than a physician loan. And I was really surprised. They did have 20% down. So I think if you are in that category where you do have 20% down, don't alienate yourself just to physician loans. But generally, if you have less than 20% down, a physician loan is going to be probably your best bet, because they don't wrap in the mortgage insurance into the rate, and they're not charging you that monthly mortgage insurance.
And they don't charge you a higher interest rate for jumbo loans either, correct?
No, yeah. So that's something I teach in my first time home buyer class as well. Jumbo loans are set, like the conventional loan limits are set by the government, and they come out every year with new loan limits. Here in Salt Lake City, the loan limit for a conventional loan is 610,000. So if you were to have to get a loan for over 610,000 here in Salt Lake City, you would have to get a jumbo loan. Those interest rates can be in the fives right now, which is crazy. Or you can do a first and second mortgage if you're not doing a physician loan, where the first mortgage rate is lower, but your second mortgage interest rate is higher. And it's like a 15-year term, and there's a balloon payment. So if you don't pay it all off in 15 years, you have to pay a huge lump sum at the end. Whereas physician loans, most of them for sure go like up to 750 for most loan amounts. There are some that will even go up to 0% down for $1 million and not be in the jumbo loan territory with no mortgage insurance.
So I have a question about if we're going to be just going into residency, we're going to be making, 50, 60,000. Is there any difference in conventional versus physician loans on what we can get approved for?
So your debt to income ratio, which is what they will approve you for, is going to be the same. They usually won't qualify you for more than 45%. Now, here's the other big difference with physician loans versus normal conventional financing. If you're doing a Fannie Mae, Freddie Mac loan, a Fannie Mae, Freddie Mac will either take your income-based repayment to qualify into your ratios of how much home you can buy, or they will take 1% of your total student loan balance per month. So if you have a $200,000 balance, and that's 1% of that is $2,000 a month. Most residents are making $3,000 to $4,000 a month. If you were to go with a lender that was going to factor your student loans into your loan qualification in that way, there's no way you'd be able to qualify to buy any home at all. So most physician loans do not include your student loan debt in your ratios at all. And the other thing for residents, people who are going into residency, unless you had a spouse that worked and was making more than like 30 to 40,000, and of course this changes depending on where you're at, poverty level wise and the state that you're in. Most residents come, if you have a federal private student loan, or if you have the federal student loans, and if you got like use FAFSA and you got those loans and you consolidate with the federal government, usually if you do an income-based repayment with them, your first year of residency, if you had no income during your fourth year of medical school, or if you had no income during your last year of pharmacy or dental training, and now you're an income-based repayment, most of the time your payment's zero. Because you didn't make any income. So your income, and they always base it off of your last year's taxes. So your income is going to be essentially zero.
I had a question. So we are kind of like halfway through this process already, but now I'm not sure we did the right things. What we did is we approached lenders. We told them what our credit score was, what the approximate price of a house would be, and what our down payment would be. And then we asked them what rate they could give us and what their origination fees would be. Do you think we're at all comparing apples to apples? Because now I'm like, I feel like we did the wrong thing.
No, I think you're doing a great job. Like, for the fact that you have not taken this class, that is a step above what most people do at all. Like, that is fantastic that you've done that. That's going to really help you to try to compare. Let me guess though, most of the people came back and told you they only had like a $775 origination fee or $1,000 origination fee, right?
Well, most of them were around 12 to 1,500.
Yeah. Yeah. So most of them probably were in that range. They're gonna, what they did to tell you what their origination fee was they picked a rate that was going to make their origination fee closer to that $1,300 range, right? If all of the rates of the people that you got quotes from are not the same, then it's going to be a little bit harder to compare apples to apples. You don't have to do this process, but I would recommend, if you really want to try to get as close to apples as possible, to do this. Because if someone's giving you a 4% interest rate and they say that their origination fee and their closing costs and your payment is going to be one thing, then maybe you don't know. Maybe the other person's bank that day, at the other person's bank, if maybe you got them to give you a 4% interest rate, maybe their closing costs would be a little bit better. Maybe their bank's going to be giving you a better credit for that day, right? And so that's why trying to get them to all have the same interest rate if you can is great. Sometimes they won't do that. Sometimes you'll ask them to give you a certain rate and they'll just completely ignore you and they'll say, well, here's this rate. And then you just kind of got to do your best kind of extrapolation. If you can get them close, you usually are, most people are pretty intelligent and they can figure this out. Like after they get the numbers close enough, you can kind of get a feel. You're like, no, this product seems a little bit better. But if you're just wondering where to start and how to even start shopping around and looking around, this is a good place to start as a benchmark.
Okay, so would you recommend just like going back to them all with the same interest
Yeah.
rate saying okay. So maybe
Yeah,
just
so-
like the
so-
best interest rate we got.
Yeah, I mean, I think you did a great job. I think you did a great job with you had half of this information correctly. And who knows, maybe all of the people gave you all of these other numbers exactly the same. But if you want to like have a little bit better idea, you could ask them for this. What's the worst thing that they could do? You could ask them to all give you the same rate from the same day. And if they don't do that, then you just do your kind of your best guess off the information that they've given you. But if they will do this, it's going to make it a lot easier to get that common denominator and look at the numerator to figure out who's going to have the highest or lowest origination fee.
Okay, thank you.
Okay, cool. Any other questions?
So I have a question. I don't know if you're going to know the answer to this, but on your rate sheet,
Uh-huh.
have you ever run the numbers on what the break-even point is on those incremental ones? What I mean is, like, if you pay the loan out to 30 years, obviously the bank is going to make a lot of money off of that.
Uh-huh.
But if you get a 30-year loan and you plan on just paying off the whole loan in 10 years, would it be smarter to get a higher interest rate and get
Yeah.
their credit? What's the break-even point there?
That's awesome. That's a great question. And that's a question that a lot of my clients ask me when they say, and so when I'm trying to help them decide, they're like, well, I have the $6,000 that I could pay out of my own bank account to get this lower rate, but like, would it be better? Like, what's the break even point? They have that same question that you have. So usually what I say is okay, well, if you were to pick this 3.375% interest rate, and they're only giving you $213 of credit, you're essentially not getting any help in closing costs. So you're going to have to bring $6,000 out of your own pocket to do that. So then what we do is we look at the difference in the payment. So this one's going to pay for essentially all of their closing costs. This one is not going to pay for all of their closing costs. And then what we do is we look at the two rates that lender or loan officer has given them, and we look at the total payment. This one says $1,316.97. Sorry, I'm just trying to grab my phone so I can do some math. So this one says $1,316.97. This one has a higher payment at $1,376.88. That is a difference of, so $1,376.88 minus $1,316.97. So it's essentially $60. So if you were to put down $6,000 on this rate, and this is just talking about short term, this isn't even talking about the amortization table of what you're going to save long term interest wise. This is just like short term break even point. So if it's $60 a month difference in this payment, if this one's going to get you a lower payment, but you have to pay $6,000 up front for it, and this one, is going to have a little bit higher payment and it's going to be $60 more a month, but now you get to keep the $6,000. So then what you would do is you would say, okay, $60 a month. So I'm going to take that $6,000 and I'm going to divide it by 60. And it would take 100 months It would take 100 months for you to make your money back from the money that you would put in terms of just the payment. This isn't talking about the full amortization schedule of how much you're saving in interest. Just in the payment, it would take you 100 months, which divided by 12 is 8 years. So if I were going to, if I was having this conversation with my client and I was saying, hey, it looks like if you were to put $6,000 and get this awesome lower payment, it's going to take you about 8.33 years to recuperate that cash by the money you've saved in your monthly payment. And that's when we start to talk about house goals. I say, how long do you see yourself in this home? Do you see this as a residency home? Are you only going to be here for 4 years? If you're only going to be here for 4 years, it doesn't quite make sense for you to buy down the rate and pay that $6,000 and get the lower monthly payment. If you were to just keep that money in your bank account and use that extra money for the payments, then you're going to save money in the long run. Now, if you're going to stay in the house for 30 years or any longer than 8 years, that's your break even point. You're totally going to be able to make that money back. And so it's very dependent on your home goals and what you are deciding to do, whether to buy down the rate. And you're not going to be able to see this part. But what you will see is they'll tell you what the rate is and they'll tell you what the payment is. And so then you can make that comparison and say, okay, which one's going to save me in the short term, that closing cost money. And then you would have to plug it into an amortization table to calculate how much it would save you over the life of the loan. And then you kind of decide if that's worth it. Does that make sense?
Yep, very cool. Thank you.
Did that answer your question?
Yeah, definitely. Thank you.
Cool. Awesome. Does anyone else have any other questions?
I have a question. This may be completely unrelated. I'm just not sure, but if you're thinking the house you're buying is going to need some like renovations before you move in, does that factor into your initial mortgage loan at all?
So the only way that would factor into your mortgage loan is if it would underappraise. So for example, if you're trying to purchase a home and an appraiser is using comparable sales in the area that have appraised for more because they've been updated, then that house is probably not going to appraise for as much. But you can't wrap in, in a physician loan, you can't wrap in like extra costs for like renovations. So say you wanted to replace the flooring in the house and you wanted $10,000 to do that. The lender won't like wrap that into your mortgage. They won't add that in. If you did an FHA 243 loan, I believe is what it's called, sometimes they'll let you do it. Those are not common and the interest rates are so much higher. So it would be not something I would recommend. If you were trying to do some renovations on a home and get money to do that, the best way to do that, if you needed to negotiate and you say, hey, this house needs some renovations, it's kind of run down, the best way to do that would be in this seller concessions page. Because if the seller is going to pay for $6,000 of your closing costs, now that means that, hey, you could either get the lower rate or you could still keep the higher rate and now you get to keep that $6,000 of cash in your pocket. So now you have the money to do the updates. Or you can negotiate that into a purchase contract where you ask the seller to do it. Did that answer your question?
Yes, thank you.
Cool. Any other questions?
Is there any difference at all with a new build contract? New construction?
So new construction, that totally depends. If you're doing a new construction loan where the builder is carrying the loan, that's what it's called. It's called the builder carries the loan. So they are the ones who are doing the construction loan. They're making the payments during the construction loan period. If you were to do that kind of builder, then it would be the exact same physician loan as if you were going to go find a home down the street that was already existing. If you were going to be doing a custom home or a semi-custom home where the lender or the builder wouldn't finance it, then most physician loans will not do new construction loans. They'll only do the permanent financing part. And so to answer your question, the real estate purchase contracts are different in those, and the financing is also different in those. Most builders have their own specific purchase contracts that they make you sign that are not the general state approved ones. Did that answer that?
I think so. Thanks.
Okay.
Will our student loan payment affect what we qualify for and our rate?
It depends if what kind of physician loan you use. Some lenders will use your minimum payment or your income-based repayment. Others won't factor that in at all, which means that in my first-time homebuyer class that I taught, I had a formula that I shared with people. For about every $50 of debt that you have, like monthly debt payment, that equals about $10,000 of home that you could qualify for if you got rid of it. So with if you had like a $50 a month student loan payment and you're going with a lender that has to calculate that $50 in, it means you're going to qualify for $10,000 less home. So physician loans, if they don't, the ones that don't factor in your student loans into your qualification ratios, means you can qualify to buy more home. Did that answer that question?
Yeah, it does. We just refinanced ours for a high payment and low term.
Okay.
So I just don't know, because we decided to try to pay them off in a year to a year and a half more.
Yeah,
but
yeah.
Then we won't have a down payment.
Yeah.
We won't have loans. So I don't know what the best route to do is, to pay off the loans or to try to get into a house.
Yeah. And that is a really hard decision. It's one that my husband and I have been struggling with for forever. So I totally understand where you're at with, do we pay off all of our debt and then get into a home, or should we get into a home and then, you know, and then kind of get the lower payment on the loans and pay it over longer. So if you're qualifying for a physician loan and they're not calculating that in your ratios, you might be able to do both. I don't know if you financially want to do both, because then you have like a bigger house payment and you have a larger loan payment. So that would just kind of be up to what you feel comfortable financially qualifying for. But I'm pretty sure that there are lenders out there that wouldn't even calculate your higher payments on there. Now, it's also important to note that some physician loan lenders have different qualifications, meaning if your loans are private versus if they're federal. Some lenders just don't care about what kind of loan it is at all, private or federal, and they'll just won't calculate it into your ratios at all if they're your student loans from medical school. Some lenders, if you've refinanced to a private company and you're no longer with the federal government, they might actually calculate that into your ratios. And that's why it's good to shop around to figure out which ones are doing that and which lender would be best for your situation. And maybe they might have a little bit higher rate for some certain programs, but you just have to kind of balance what is going to work best with your financial goals and what you're trying to do. So. All right. So I think that's all I have time for tonight. If you guys have any other questions, I mean, you're so welcome to message me. I hope that was helpful and that you gleaned some information from that. But I'll probably teach another first-time homebuyer class coming up maybe after match day, just in case someone missed out on that one. But thanks everyone for coming. And like I said, if you have any personal questions, you're welcome to personal message me. And when I have time, I'll try to get back to them. So I am going to end this. Thanks everyone for coming. And then I'm going to post the recording of this on my page, and I'm going to post the recording of this on some of the other pages that I said I would do this on. So other people can watch it later. So thanks everyone for coming.
Thank you so much.
Yeah.
Thank you.